Hi everyone, and welcome to this video. For those of you who don't know, my name is Tom Buck. I'm the owner and managing director of the Calder Group, including Calder Finance Midlands Limited, and we're putting out videos talking about what's happening in the market, where we are currently, particularly as COVID is around and about, and talking about the opportunities that are there and things that as investors people should think about going forward, and cutting out all the media and really getting down to true facts and information. I'm pleased and privileged to welcome today Keith Speck from Morningstar. Hello, Keith.
Hi there, Tom. It's great to be with you.
Yeah, well, thank you very much for taking time. I know how busy you are at the moment, and pretty much a bit like me, watching the news almost on an hourly basis, waiting to see what the next problem, issue, movement is going to be.
Yeah, and trying to cut through some of that noise as well, and really focus in on the longer term.
Yeah, well, I'll come to. I've got just 2 or 3 questions at the moment to ask, but I thought it's only fair. The first time we've done this together, start with explain to me who Morningstar are and what it is you do.
Yeah, I'm more than happy to do that. So I work as a portfolio specialist at Morningstar. So essentially a link between our sales team and our investment team. My background is running fund of funds and private client money for 20 plus years. So been through the mill a couple of times with regard to market cycles. And who are Morningstar? Well, we're very well known as a research house, a fund research house. Less well known probably in the UK for the equity and credit research that we do, but we are the largest independent research group globally, so a lot of people. And the part I sit in, the investment management side, we run a range or ranges of managed portfolios for advisors to use with their clients on a range of platforms. So we have 6 different ranges of portfolios and 27 portfolios in all.
So yes, I must admit, yeah, we use Morningstar within our own practice at the moment. We've been researching. I've put my local representative from Morningstar for his paces, shall we say, making sure I understand what's going on within the portfolios, understand what clients it's right for, and so on. And I think clients will normally spot, particularly the self-investors will know, because there's the Morningstar ratings on various funds that a lot of independent research tools use.
Yeah, absolutely. It's what we're best known for.
Yeah. So okay. Well, I really want to try and get a hub of where you think we are at the moment, because obviously, if you've turned on the news, I think this week alone we've seen stock market falls. If you listen to the headlines, they talk about plunges. I think 2% is now a movement in the day. It's pretty much the new norm. I won't call that a plunge anymore. That's almost a kind of okay, it's moved 2%. Where do you see volatility at the moment, though, Keith? Because obviously we're picking up lots of bits. I think this week, if you listen to the press, it's been because American COVID cases have been going up. There's obviously the US presidential election around the corner. There's Europe, where Germany have locked down parts of Germany. Is COVID-19 the sole reason for all this volatility, or are we seeing other factors that are perhaps being masked behind the scene?
That's a really good question, Tom. And yes, by turning on the news programs, we are certainly bombarded with a lot of noise, with a lot of unknown or unknowable outcomes. And what people dislike the most is a sense of the unknown and the uncertainty that goes with it. Perhaps before getting on to where we see sort of volatility going, and maybe where we see opportunities in the markets now, if we look back, maybe chat about how we think about investing and look at what we've been seeing this year. So we take a long-term fundamental valuation driven approach to asset allocation, and we've got a vast team, fantastic resource. We've got over 100 professionals across the globe that are carrying out the research into over 200 equity markets, 100 fixed income markets, and their job is to look for sectors, countries or regions that are fundamentally attractive and trading below their fair value or what they're actually worth.
Yeah.
So if we think of the volatility that we've seen this year, and if it seems it's only 6 months ago, but the end of 2019 was actually pretty much the end of the longest bull market in history. Back at that point, we felt asset markets on the whole were looking expensive, trading above their fair value, and in some cases by quite a margin. So as we came into the year, we ended 2019 fairly defensive and came into 2020 defensively positioned, carrying a lower weight to equities than we would consider normal, had very limited exposure to investment grade corporate bonds and no exposure to high yield. So that we didn't know what the trigger for a sell-off would be, but we knew valuations were expensive. So the sell-off in equities and credits resulting from the COVID-19 pandemic has meant that overvaluation in many markets has reversed. Some markets became cheap and others reverted more towards fair value. So we followed our process. We took advantage of the value on offer in some of these markets. So we increased equity exposure, we increased investment grade credit weightings, and introduced high yield bonds to the portfolios on the back of the widening in spreads or the additional yield that you're getting from that high yield bond over a government bond of the same maturity.
Yeah.
So late March seemed to mark the lows, and we've seen a pretty sharp rally in the prices of many risk assets. A bit more volatility has come back into the markets more recently, and some of these assets have moved back into expensive territory, and some back to being more fairly valued. But even with that said, we do see opportunities over the longer term for investors who are willing to take that longer term view.
Yeah, because one of the things I've noticed and I've been aware of is when you look at all the press headlines at the moment about Intu, who I don't know if they've gone into administration today or not. Hopefully not. We had Go Outdoors earlier this week. Even talking about locally here, Rolls-Royce and job cuttings, it seems to be, and perhaps it's the way I'm viewing it, it seems to be that companies that are going through real trouble at the moment were pretty much dead before the COVID-19 shutdown, and this has just brought about the end that was almost being put off by normal trading. Is that a fair description of what we've seen? So actually, the good companies are now rising to the top. Those saddled with debt in areas where there was trouble are the ones that we're hearing about now.
Yeah, I think if we look back over the period since the global financial crisis, it's been a period which has seen companies artificially propped up, if you like, by the cheap money that's been available, the actions from central banks across the globe. I think, as we're moving into, and one of the things that we look at when we're looking at valuing asset classes is the availability of capital. Is capital cheap for companies to access, or is it more expensive? And certainly, weaker companies over the past decade have definitely been kept alive by access to that cheap funding that they've been able to get.
Okay, so in terms of where clients are at the moment, because obviously what my clients have seen over the last 3 months is that big dip. it's come back. We're big believers in asset allocation, which is part of the reason why we use Morningstar as part of our proposition for clients and part of our options to look at asset allocation. Is that changed dramatically for Morningstar in the last few months based on what you said earlier about things now being perhaps fair price or below fair price? So is that changing how you're viewing asset classes?
Yeah, absolutely, Tom. As asset classes got a lot cheaper, we were able to introduce more risk into portfolios. I mentioned increasing our corporate bond weighting, our investment grade bond weighting. In some of the portfolios, that actually sort of doubled from being sort of mid-single digits up into the low teens, depending on risk profile of the portfolio. One of the big questions that we've been asking ourselves following the rally is, should we be taking risk off the table? And I mentioned one of the things we look at being capital supply. The other three things that we're looking at would be fundamental risk. So that's about company profits and cash flows of the assets that we own, and where's the risk of a big collapse or a permanent loss there. Valuation, so as we've mentioned, are assets cheap or expensive? Investor risk aversion, are people getting carried away, either being far too optimistic or pessimistic? And then finally, capital supply. When we've looked at those pillars recently, we come out with a medium rating. So, for the time being, we don't see it as being the moment to take risk off the table. That said, it has to be, you're taking risk in the areas that you favor in the right types of assets. But for the time being, we're content to retain the positioning that we introduced late in March and through April, building up those equity and credit positions, but being very mindful, if we do see another big rally from here, then those valuations are getting stretched back into expensive territory. Yeah. Do we then need to lower risk? Or if we see asset prices pulling back, again, for us, that represents an opportunity. Cheaper asset prices come with the lower risk of a permanent loss of capital for investors. Yeah, maybe you sort of one of the areas, and by no means do I want this to be seen as giving investment advice and jumping into your shoes, Tom. You do a fantastic job of that yourself, but to give you a flavor of some of the other assets we've liked in portfolios, the big sell-off we saw, or the big fall we saw in oil prices, led global energy companies to look very attractive for us. So we were taking up some exposure to world energy. So that became a sector that looked quite interesting on a long-term view, even if oil stayed around the $30 price, even with dividends being cut and the potential for dilution through capital raisings.
Okay, so yeah, again, I suppose it comes down to, with volatility with any investments, it's still very much, it's the asset allocation is key to keep it within a range of movement that clients feel comfortable with. But I think we've now seen that range of movement is potentially higher than it was ever before, because we're in a period that we don't know what's going to happen economically or politically in the next year or two. But really, then clients ought to be looking at how much risk do they take, how much equity do they build in, based, again, it's the old fundamental of, are you investing for a 5 to 10 year period, or are you planning for your retirement and you've got a 30-year period? That's still very much the view that you're taking as a portfolio manager.
Absolutely. Whenever we're assessing an investment, we're not thinking of the next week or the next month, the next year. We're assessing these on a 10-year view. So we, as I said at the outset, we take this long-term approach. We don't know what tomorrow brings. We don't know. With politics, where we don't profess to be political experts, but what we do think we can bring some value to the table is in our research into the long-term cash flows of markets, of companies, and assessing whether assets are cheap or expensive on that long-term view. The classic Warren Buffett quote, his favorite holding period is forever. Quite hard to do in practice, but we would ideally be holding these assets for the very long term. And within portfolios, we look at different vintages of assets. So we'd have some ideas that are new, as I mentioned, energy. We'd have some ideas which would be at a more maturing stage, and then those which have matured and would be finding their way out of portfolios.
And then that, of course, is reflected in the returns I'm seeing in the Morningstar portfolios when I'm looking back at that past performance. Obviously, we saw everyone go through the same period in March, but it's how quickly that comes back, and the positioning. And what I look for as an advisor is always, what are the managers? What are you doing, Keith, that I can physically see and understand going forward? So I just want to ask one very quick question. Are you building in, or are you just saying, well, if we go into a recession, depression, actually that's not going to affect, because you're looking for value, because you're looking for the next opportunity? It almost doesn't matter in terms of the investment profile, the investment style, because you've got that 10-year view and you can see where markets are eventually going to go at some point.
Yeah, it's an interesting one. Obviously, if we do go into a recession, or we're going into a recession, a depression, however deep it is, that does have an impact on longer term cash flows for companies. So we would have to adjust our thinking on those potential cash flows to reassess whether or not that asset class remains attractive. But if we see markets falling out of bed, and the investing journey, it's an emotional roller coaster. As markets plummet, a lot of people will panic at that point and look to raise cash, which is just at the time when that's the worst point to look to raise cash after the market falls. For us, we think of it the other way around, that a sharp falls in markets create opportunities, that you're going out and buying when others are fearful, stealing from Warren Buffett yet again.
I must say, yeah, we're going to end up paying an awful lot in copyright to Mr. Buffett if we can. Keith, thank you very much for your time today. I know we're going to be talking pretty much on a quarterly basis to see how things are progressing, see what the world is doing. But I think from this, it's a case of, the volatility is here, and it's just almost live with that volatility as it stands. Keep in mind that long-term view. So again, down to my job there, making sure the clients are invested in the right portfolios, the right mix of assets to meet that time scale. And also pretty much a case of trying not to be emotional. And again, I understand it from the financial advisor's point of view. I'm dealing with my clients' dreams and wishes and their hopes and fears for the future. So it does become very emotional, and it is a difficult time. But I've got to say, I've got wonderful clients who have pretty much, by and large, stayed the course, and hopefully are now starting to see the return.
That's good to hear, and we all like clients who are happy to stick with their plan. They know that their plan has been carefully thought out, and that trying to avoid the emotion of the moment and look through that is hugely important.
Yeah, and as usual, to the clients who are watching this, again, if you need to talk, if you need to explain or have me explain where we are at the moment, what's happening in the portfolios, what's happening in your investments, and the impact this is having on your long-term goals, again, contact details are always there. We can talk now via Zoom, Teams, We can do telephone calls, and within reason, now things are coming out of lockdown, we can start actually potentially having face-to-face meetings in the same place as one another. You never know. Keith, thank you very much for your time this afternoon. It's a Friday afternoon, coming up for 5 o'clock. It's sunny. It's wonderful. We're supposed to have thunderstorms, but I think instead we're going to have another balmy evening. So thank you very much for your time, and I'll let you go and enjoy a cold glass of wine or beer, or if you're on a health kick, a water.
No, thanks for having me on the call, Tom, and really look forward to the next one, and hope everyone stays safe.
Excellent. Thank you very much, Keith. Stay safe yourself. Have a great weekend, and yeah, we'll speak to you in 3 months' time.